Three. We have had a fairly strong quarter in a seasonally weak set of period. We are ending the quarter with a revenue of 37,300 odd crores, and in dollar terms, that's $5.25 billion in revenue. Importantly, it's the growth on a constant currency terms is 12.1% on a year-on-year basis, and in dollar terms, we now have closed calendar year 18 with $20.5 billion of revenue for the calendar year, and that's a growth of 10.3% in dollar terms from calendar year 17 to calendar year 18. Overall, the rupee growth is at 20%, aided by currency benefits, and for the quarter, the year-on-year growth for Q3 to Q3 is at 9.7%. The growth has come with a good margin defense. We are ending at 25.6% for the quarter, and on a year-on-year basis, that's an increase of 44 basis points, and growth in terms of the annual operating profit growth of 22.9%. We are on target to improve our full-year margins. On a 9-month to 9-month basis, this is an improvement of 118 basis points at an operating profit margin level. Coming on to net profits, we have crossed another big milestone in our journey, crossing 8,000 crores of quarterly net profit this quarter, ending with 8,100 crores of net profit, which is a growth of 21.7%, or rather it's a margin of 21.7%, and translates at an EPS level to a growth of 26% for the full year, for the year-to-year basis. Similarly, we are quite happy with the cash conversion. We generated 8,600 crores of operating cash from operations this quarter, which is a cash conversion of about 107%. We are ending the quarter with 43,800 crores of cash and investable surplus. So overall, a fairly strong set of financial performance, and it is coming on the base of very strong business growth. I'll touch upon parts of that. Firstly, from a customer portfolio perspective, we have seen expansion across all customer portfolio levels. We have now added one more customer $1 million plus range from a quarterly basis, and on an annual basis, we have added 8 customers. So we've gone from 37 customers to 45 customers in this band of 100 million plus. From services perspective, digital continues to power growth. We have now crossed 30% of revenue coming from digital, and it's growing at more than 50% year on year. From a segmental perspective, North America growth acceleration continues. North America year-on-year growth has now come in at 8.2%, and Europe and UK continue to do well, which is continuing a trend that has been there for the last few quarters. The growth from industry segment perspective, very encouragingly, BFSI continues to accelerate its growth trajectory. This quarter is at 8.6% year-on-year growth, with strong growth coming from North America, from insurance, and very broad-based growth across the insurance segment. And as I said, from North America, despite some impact in UK and Europe on the banking side of it. Retail, in a very seasonally weak quarter for retail continues to maintain its greater than 10% growth rate at 10.5% on a year-on-year basis. And other segments which have been showing good growth, like life sciences, healthcare, energy and utilities, all of them have continued to deliver well on the growth journey. So overall, a strong quarter, strong pipeline. Our order book for this, or rather the total contract values closed in this quarter, which is at $5.9 billion compared to $4.9 billion last quarter. So good order closure into this quarter, strong pipeline build-up also. And from a manpower perspective, our attrition continues to remain very low, industry-leading retention. And we added 6,800 new headcount, net headcount in this quarter, and totally 27,000 for the year. This compares to a net addition of about 7,000 last year. So very strong demand being serviced with a very strong addition on the headcount and on the capacity side. So overall, a strong quarter to wrap up the calendar year, and a strong pipeline and strong order flow that sets us up nicely going into the new calendar year. With that, I'll open it up for questions.
Thanks, Rajesh. The first question comes from Kritika Saxena from CNBC TV18.
Hi, gentlemen. Happy New Year. Rajesh, as far as the overall deal pipeline is now concerned, we are beginning 2019. What's the sense that you are picking up? Because there seems to be some concerns with respect to macroeconomic stability, possibly impacting deal pipeline. So where do you see year-on-year deal pipeline? Is it likely to remain flattish, or could we see a marginal negative growth as well?
Kritika, from where we are, we see strong deal momentum. As I said, the order closure this quarter has been steadily increasing. It's grown almost 20% compared to last quarter. And on the pipeline front also, we are seeing steady build-up of it. But macroeconomic trends are something that are external, hard to predict. If something like that comes around, definitely it will have some impact on it. But right now, we are not seeing any impact into the medium term. And but as the year builds up, we'll have better commentary on it.
But is it the same as last year or slightly better in terms of the deal?
In fact, our deal pipeline adjusted for the one-off platform deals that we had, we are much better than where we were last year.
Okay. Some color, Rajesh, with respect to BFSI in North America. By when do you expect BFSI, the kind of pace that you used to see, by when can BFSI growth come or cross the industry company growth average?
I would first let it come up to the company average, but see, if you look at it, it went from 4% to 7% to 8.6% this quarter. So it is steadily improving Q on Q. And especially in the North America sector, BFSI is doing quite well. In fact, North America BFSI has done well for us, and insurance overall has done quite well for us. So we're quite positive about the momentum that we see in BFSI. It's difficult to say when it will cross a certain threshold, but if it continues in its current journey, we will be exiting the year close to a double-digit kind of a growth rate. Okay. So that should be that would set us up nicely.
And how long would you expect the UK minor tremors in BFSI to continue?
Difficult to say. We'll have to wait and see. That market is right now a fairly complex market. So we are participating well, but difficult to say as to what the impact of that will be given the short-term uncertainties in that market.
Okay, but very quick last question. Ramki, with respect to margins, can you break it up for us? And also, as you enter Q4, the kind of volatility that you're seeing, be it on-site costs or be it rupee appreciation, is increasing. So, A, do you stick to your margin guidance, and by when can you reach that level?
Okay.
And if NGS could give some more color with respect to the digital incremental growth, now that you've reached scale, could a quarter-on-quarter growth perhaps reduce in the next coming quarters?
Okay. On the margins, see, from a revenue perspective, we had a 1.8% constant currency growth. But on a rupee, it is 1.3. So obviously, the currency there has been an impact of 50 basis points on the revenue. See, dollar as a headline number, there has been some slight rupee depreciation. But across all the other currencies and a basket of currencies in which we operate, actually there has been an appreciation. So on an overall basis, there has been a sort of rupee appreciation from that perspective. So from a margins, obviously there is an impact from the overall at the revenue level. Also, we have added, as Rajesh said, close to 6,700 net in this particular quarter. And over the last 9 months, we have added almost 27,000, which is the entire full year we were doing 7,000. If you look at the orders we booked, the growth which we are seeing in the various markets, as well as also in BFSI, etc. So we have been adding people. So the cost essentially in this quarter is primarily on the people cost, where we are seeing the growth opportunities and we are filling that. So that is where we are currently. On going forward basis, it's very difficult to predict on currency, obviously. So and currency depreciation is intrinsic to our business because the model really works on the principle that where it's an inflation difference between where we serve and from and where we serve from and where we serve our customers, that is really helped only by currency depreciation. So it's a mix of the cost and currency depreciation. So we will see how it goes. We are very much focused on our preferred range. There is no necessity to look away from it because if you look at all the parameters, 9 months, 12 months, our operating margin, net margin, everywhere we are higher than even our revenue growth. We are talking of 25% growth year on year. And even on a 9-month basis, our operating margin is 25.7. So absolutely no reason to look differently from where we have been. So we'll stay focused.
I think digital at 30% growing at 52% is phenomenal. Every one of the service offerings that we have launched under Krishnan's leadership has received enormous amount of traction in the marketplace. So I don't see it slackening at all. At some point in time, in fact, we earlier commented that everything that we do will turn out to be digital. So I don't see it slackening at all. And the demand environment that we see in the marketplace across geographies, across verticals, it's really encouraging. And we have further solidified our double-digit growth aspirations and growth momentum, and we have secured that pretty much for this financial year. And it's a conscious call that we made to capture the demand that we have, to tap into the skilled resources that we need, right? So we have hired more in this quarter. It's a conscious call that we made, and that has impacted slightly on our margin. But you will see that playing it out for us in terms of capturing the demand, and especially that $5.9 billion worth of TCV that we have made this quarter should all come up nicely for the next financial year as well as the next quarter.
The next question comes from Neha from BTVI.
Good evening, gentlemen. The first question is, as we enter the new year, going forward, your outlook in terms of growth drivers for the year as far as your business verticals is concerned. First question is that.
As I said, we are going in with a pipeline that looks to be quite strong and better than where it has been in the past, both from an order book value perspective as well as from a pipeline. Obviously, there are challenges on the markets which are fairly well documented and widely discussed. We have no incremental insights on it. As this quarter goes through, we will start getting early indications of whether this demand is really translating into closure. And that would be a good objective point to look at it. Right now, we are well positioned and we are participating aggressively, and we are fully loaded.
But in terms of verticals, as far as your
verticals, almost all the verticals, if you look at the growth, actually across the board, you will find very strong, either double-digit or trending to double-digit growth. Communication, which had a weak quarter last quarter, that's back up. The residual impact is in manufacturing, and technology sector continues to be highly volatile and challenged. The manufacturing part of it also, we are seeing strong offtake in North America. And it's really UK, Europe manufacturing that is right now a bit soft. And obviously the reasons for that are fairly well documented. The technology part of it is more, there are accounts that are doing well, accounts that are not doing well. And that sector is a very complicated sector, doesn't have a secular trend. But beyond these two, almost 70-80% of the remaining business is on a strong trajectory. And then if you look at it from a geography market perspective, emerging markets are volatile, but the major markets, we are seeing strong opportunities.
Secondly, a bit of an update on the acquisitions that happened in November. I'm talking about Bridgepoint Group and W12 Studios. As update on how the integration is going.
They're fairly small operations, so integration is fully done. They are very unique assets, and it's really not an integration one. It is about how that grows in, and how we leverage that and use that as a driver for our growth. But it's, as I said, the unit is fairly small, both of them. So integration is really not a big issue.
And the larger acquisition strategy for 2019?
No change to it. We participate and we are fully active in the deal market. Right asset at the right price at the right time. We are always game.
Sure. Thank you so much.
The next question is from Pranay from ET Now.
Good evening, gentlemen, and thank you for the opportunity. Seems that the winter has been warm for your business, so good growth. My compliments on that. About the challenges, why I speak is because some recent comments from Accenture results indicated that BFSI, while North America is doing well, but Europe and parts of UK are now becoming a sore point. So do you think those challenges could actually manifest for some of the larger IT service vendors like yourself? And in terms of other areas, retail as well as let's say even digital for that matter, do you think this kind of momentum which was witnessed in Q3 is going to extend through the next few as well? Because last quarter you said that near-term outlook is good, you have enough business in hand. Focus is now moving to medium-term outlook. So double-digit kind of growth, can that be extended into 2019 as well?
Okay. Multiple questions. Let me try to answer it. We are seeing growth. We are participating in growth in BFSI. As I said, North America banking is very strong. Insurance is strong. There are challenges in Europe and UK, but what is the extent of the challenge will depend on a vendor-to-vendor situation, I suppose. We are right now seeing good growth and we are participating aggressively. Beyond that, how does the macro play out? Very difficult to call, but we see ourselves as participating on either side of that. We are both part of the growth and transformation part of it as well as on the optimization side. So overall, I think there will be net opportunities irrespective of short-term volatility. So we're quite confident about the BFSI story and it's the trajectory that it is on. Retail, it's a good question. Again, it's a complicated industry. If you have been following retail sales data coming out, it's been a very strong holiday season for retail, and that's very I think it's about 5-6% growth, and that should flow through into the financials of various companies. On the other hand, obviously there have been bankruptcies and near bankruptcies. So our approach to it is that it's an industry that is going through transformation. And we are participating very aggressively in the growth and transformation agenda of our clients, which is primarily driven on technology and digital. So we remain quite positive, and one-off events will have to be dealt with, and those cannot be predicted by definition. What was your third question? You had banking, retail, and
digital momentum. This 30-40% kind of growth. Do you believe this momentum is going to continue?
We think so. It's now at it is over a tipping point. So it's only a question of timing rather than any residual doubt of whether this technology transformation will continue. So it's well beyond that tipping point, and we are likely to see very sustained demand on it, and which is the reason we are continuing to invest in creating that capacity for it, both training wise and hiring wise, and building ourselves for that demand that we see.
So growth is going to be reasonably good, and winning business is also not really any difficulty for you given the large deal closures that you mentioned and the net additions that we are seeing throughout this year. So you're clearly positioning to service that. But when it comes to execution, we have seen quarter on quarter there is a volatility. This time there's a 90 bips dip on margins. I saw that in comments you mentioned currency volatility is when you mentioned 50 basis point impact of that, but also higher cost of doing business in some markets. So is this something which is going to be around 40-50 basis point? Is that reasonable to assume? Why I say that is because you're sticking to your 26-28% margin band, and given that rupee has retreated, even if it stays stable, achieving or staying above the lower end of the band is going to be a little bit of difficult, even though you have execution prowess and efficiency.
Let me take part of it and then I'll go to Ramki. We saw typically Q3 is a weak quarter, but going into it, we saw the demand pipeline, we saw the demand, And we wanted to make sure that we are participating in the demand and capturing as much as possible, especially in the North America sector. So yes, there are supply constraints and there is a cost element to it, but it's a strategic call to actually invest and pick up the demand. And we believe that we have the ability to optimize. It will take some time to optimize it, but so you will find that we are higher on the employee cost compared to it. Bulk of the margin decline that you spoke about has primarily come from on the employee line, both on the capacity as well as on the subcontractor part of it. This is something that we can optimize over time, but it will take some period of time to go through. Larger term structural changes to it, campus hiring, getting the pyramid right, substantially working on reducing the attrition to our India levels in our foreign markets. These are all structural factors that will help us get the cost part of it right, which will take time to play out. But this is essentially what has given us the margin leadership in India. And as we increase volume in other markets also, the same levers will help us play this out. So our strategic intent is to participate in demand, in opportunity wherever we see it, and first capture it and then optimize.
Okay. Just last thing, 27,000 is the addition so far this year. So what's the plan for this year end, and how much of that is going to be apportioned for US or maybe overall developed markets, but particularly US?
So overall hiring has been pretty strong. I think as we have mentioned, this particular quarter it's been about 6,800, and if I look at the first 3 quarters, Q1, Q2, Q3 is about 23, and from last Q3 to this Q3 in the whole year basis about 27,000 net. So and given the demand, our strategy has been to capture the demand, and we are going ahead with hiring. I also talked about the kind of changes that we have done as far as our campus hiring is concerned in the last press conference that we had here. And we have completed our campus hiring for the next year, and we have given out offers for the trainees to come and join next year from that point onwards. So I see that the demand, given the kind of demand that we have, given the kind of pipeline that is there, our hiring is going to remain strong. And we are hiring pretty strong as far as our US market is concerned and the major market is concerned. For example, this particular year, if I look at, our total net addition that we have done in US is the highest that we have ever done in US. So we have been creating jobs. I think it has come out earlier also when we had stated that if I look at our own research, it shows that we are one of the top 2 job creators in the industry in the US market. And we continue to remain in that, at least we are pretty confident that we will be in that position going forward as well.
When you say strong, if 40% business comes from US, how much is hiring on the total?
So the percentage wise it is difficult because then it is the way the things get allocated. Some of it will be in US, some of it in various other markets. Delivery is happening global and in an agile world, so it will be different. But as I said, we have not been giving geography wise breakup in our numbers, whatever numbers that we have been hiring. But I gave you some indication that what we have hired net as far as this year is concerned in US is the highest ever that we have done, and the hiring remains pretty strong.
Next question from Sajid from Bloomberg Quint.
Good evening, gentlemen. Rajesh, I wanted your thoughts on the Gartner statement that for 2019 the IT spends would be around 3.5% versus 2018's 4.2%. In your interaction which you did with many of your clients in Q3, did you see some bit of slowing down of IT spends going into 2019? Can you give us an idea of what kind of, because you did a survey with all your clients.
I don't know the specifics of the Gartner report that you're referring to, so I can't comment on it. But from our own interactions with our customers, we have not picked up saying that it's going to be a significant reduction next year compared to last year. We have not picked up any such trends. But as I said, the quarter in which you get better clarity on what the real budget and spending pattern for the year is likely to be is this current quarter, so the Q1 of the calendar year. So we'll see as how the year unfolds.
Your digital revenues are now 30% and growing at over 50% year on year. When we spoke to you in Q3, you spoke about the fact that how IT spends are now becoming part of SG&A expenses. Do you see a growing trend of that happening? That it's not incremental now; it's part of the the entire process chain, and now the TCV which you got 5 billion is more of that coming into the play rather than incremental ones?
I think so. In many of the industries, the spend is coming across the multiple functional areas, both on the SG&A side as well as on the core side. So that is part of it. When we say we are becoming more embedded in the growth and transformation agenda, that participation is across a variety of functional lines, and that is what is driving this increased participation.
And the TCV which you got of over 5 billion, will you be able to give a breakup of segment-wise or vertical-wise?
So we have been giving broad breakups. It's from a geography perspective. North America is continuing to be strong. It's more than 3 billion of that is coming from North America, which is considerably up compared to where it was last quarter. From a vertical perspective, BFS is contributing more than 2 billion in that, and similarly retail is about 800 plus out of that. So it's fairly well balanced across both geographies as well as verticals.
Is energy back in the play?
Very much so. Energy is growing at, if I remember correctly, 17-18%. So that's this thing.
NG, I just want your comment on Europe and UK business. UK growing in mid-20s and Europe in high teens. Do you see that continuing, and what is the kind of challenge that you see? Because going into next week we have a Brexit vote coming in, and it's a challenging time there because for the Prime Minister to get that out as well. What is your view on it?
You can't comment on Brexit or no Brexit.
How are you prepared for it? Let me ask you this.
So I think, we are pretty focused on our clients and the demand environment that we see out there and the opportunities that our clients are giving towards us, right? We see an all-round demand across verticals. There is some softness that we see in some of the customers, and especially in the banking in UK and Europe, but I think it's only a question of time before they also catch up with it, right? Whether it is manufacturing, whether it is retail, or across Central Europe or UK, we don't see any particular thing to call out, okay? There are certain uncertainties linked to Brexit. I think we hope that will get over soon, okay?
Sajid, we'll come back to you again.
Question to Ramki. Ramki, except for Q2 where the margins were about 26%, Q1 and Q3 margins were below 26%, and I want to repeat the same question. Are you in line to meet this 26 to 28% margin by the end of this financial year? And what are the levers you're looking at? Because then what you're looking at is a high 26% margin, EBIT margins coming in to get that to the bottom of the band.
See, I know within the 3 quarters there is sort of went up and came down, but if you look at the 9 months, it is 25.7. So it's not very far off from at least the lower end of the preferred range. So it's very difficult to say when, etc., because definitely currency is also a factor, because that is also to take care of some of the costs. So, but the point is that we are not moving away from our strategy. We are very much focused on what we are set out to do. And I think all the other pointers in terms of the growth opportunities which are there, the pipeline, the across broad-based growth, gives us a confidence that we can definitely, and execution we have definitely demonstrated. So we will continue to focus on that and remain. So while it is a preferred range, we are quite satisfied with the trajectory in which we have been moving and how we are going. As Rajesh said, over the last 1 year, our margin has expanded by 114 basis points. So that's a journey. So we are on.
Next question from Swati from Z Business.
Hi, Rajesh. Congratulations to the team because numbers, despite being a seasonally weak quarter, are good. You talked about TCS Space in your presentation, in your remarks in the press release. That's a new brand that you've come up with, and there's a digital disruption piece that you've talked about, algorithm retailing and connected cars. Just give us a sense on where have you progressed on it, and how far do you think you want to go there?
One of the elements that has driven our outperformance is the fact that we have very strong domain knowledge and very strong technology capabilities, which have over time been, instantiated and externalized in various products, frameworks, solution sets, etc. But we have typically done this in different parts. Some of it comes out of our research center at TRDDC, sometimes it appears as an IGNIO product, sometimes it comes as a solution accelerator. And there not been an integrated view of the work that we do on the research and innovations part. So TCS Space is a brand identity under which we will bring our research and innovation and our design thinking and digital solution set into a